All right, what's up, everybody? Welcome back to the channel. It's like 6:30 in the morning. But yeah, if you're new here, I'm Eric. Today we are sitting in my room. I'm getting ready to pack for vacation, and we're going to talk about one of the most misunderstood tools in investing, and that's margin. Not the gambling version you see on Reddit, not the YOLOing options. I'm talking about a safe, controlled strategy that I personally use to accelerate my portfolio without blowing myself up. But this is not financial advice. I'm not a financial advisor of any kind. I'm literally just showing you my exact margin strategy that I personally use. But always do your own research before doing this. But this has worked very well for me, and I will continue to use it for some time. So most people hear the word margin and they immediately think danger, and that's true. If you use it wrong, it can be very dangerous. But margin is simply borrowing against your investments to buy more investments. Now, I use that as a very good acceleration tool. Key note though, it's not free money. It's not a gamble, also, though. But if used the right way, it can accelerate your growth, especially during dips, like the times that we have right now going on with all the red days and everything. But here's why margin gets a bad name. So people will, one, they'll over leverage, people will borrow too much, or people will buy risky stocks, or people don't have the income to pay it back, or people panic during downturns. Very common. You see that all the time with people. But margin doesn't blow people up. Bad decisions do. And you can definitely use it safely. And we're going to talk about how to use it safely. So here's the rules that keep my own personal strategy safe. First, I only borrow tiny amounts, like $5,000 at a time. Second, I only buy ETFs, VOO, VTI, QQQ, SCHG. Third, I never exceed 10% of the brokerage account. Four, I always have a strong cash flow. You guys know I invest $6,000 to $8,000 a month, so it pays it off fast with my contributions. Next, I never borrow during market highs. I only use it during market dips. So I typically wait to see 3 to 5 red days at a time. This prevents me from blowing up my own account or getting margin calls or anything like that. But here's exactly what I do, so you guys can understand. Every month, I borrow about $5,000 in margin, usually right after payday, and I immediately go buy ETFs like I was talking about. Then I use my regular contributions from income, side hustles, all that stuff to pay off the margin over the next 3 to 4 weeks. So every month I get into the market earlier, I pick up shares before my cash hits my brokerage account, I compound more aggressively, and I start the next month with a clean slate because I've paid back my margin over that month. So it's basically called a rolling margin. Now, it's extremely powerful when you're consistent with this. And the reason rolling margin works is simple. You're basically pulling your future contribution forward by 30 days. That's why I do this, and I've been doing it for some time. And so instead of waiting for my contributions to hit little bits here and there, 500 here, 1,000 here, 300 there, whatever, I'm buying it all now in a $5,000 chunk. And with ETFs, time in the market is everything. 30 days earlier every single month comes out to a big long-term difference. Now, here's my personal cap. Like I talked about, never let margin exceed 10% of my portfolio. So say I have $200,000 invested, that means max of a $20,000 margin. Realistically, I never get anywhere near that. I always take $5,000 loans because that's safely what I put into my account every month. But I'm usually sitting at like 5 to 8,000 before it gets paid off anyways. That's why my risk stays very low, because I don't overextend myself or over leverage myself for it. I'm just keeping it simple and safe. So margin is not for a couple things: buying individual risky stocks, trading, options, penny stocks, YOLO plays. That's where people get in trouble with margin and it gets a bad name. Now, I never use margin when the market's at an all-time high, like I talked about. I use it when it's at a low. I never use it if my income dips. I never use it if I have big expenses coming up. So if for some reason I wasn't doing side hustles that month, I wouldn't take a margin. Now, margin's a tool. It's not a crutch. But if you use it correctly, like I do, you can get ahead very, very quickly. You don't need to copy my exact numbers. I'm just telling you guys what mine is. The point of this is margin can be safe if it's controlled. And if you borrow small, you buy ETFs, you pay it back quickly, you keep your ratio low, and you don't panic during market downturns, you're fine. I've never had a margin call ever. Like, I've always been good. But you can accelerate your investing without risking your entire portfolio. Now, if you want a full breakdown of like my rolling $5,000 strategy for margins, or want me to compare margin versus no margin over 20 years, drop a comment below. I've ran these numbers myself. That's why I decided to get into margin, and I saw the difference of it. Make sure you guys subscribe. You don't miss my February portfolio update. That's going to come up. My January update is coming up, and my December update. I'm going to drop the next 3 months for you guys. I'll see you guys in the next one.